Okay, Dayna, we are rolling, and we are kicking off our coverage, 2 days of live coverage here at the CAIS Summit in Beverly Hills. Beautiful location.
Yes.
Matt Brown does an amazing job with these events. This is my second time to this summit. And we'll be covering this for goRIA, fueled, of course, by InvestmentNews, all day today, all day tomorrow. And we're going to kick off with a really special guest. We have with us Dayna Kleinman, who is the head of business development, I should say, for the wealth management solutions within Monroe.
Thanks, Chuck. Thanks for having me. Appreciate it.
Okay. I'm really excited to start this off. So Dayna and I were already talking a little bit off camera. And what I love about doing this is I'm an advisor, right? I'm really not a reporter, obviously. But I'm an advisor, and I also happen to be an advisor that's about to launch my own, at Sovereigns, a registered investment company, 40 Act Fund, which will be a fund of funds. And one of the funds we're actually looking at is Monroe. So what I love about these opportunities is I get to come out to these conferences and do my due diligence on InvestmentNews' dime. So this is a great situation for me. So thanks for joining us.
In a great venue, nonetheless, with some great speakers today. So absolutely.
All right. So with all of that said, let's get right into this. So, and really, I am looking to launch a fund. We are filing our prospectus, I think, in like 2 weeks.
Congratulations.
Yeah, it's a huge lift, as you all know.
Yes.
Right? But we think it's going to be interesting. So what we're doing is we're putting together a fund of funds of all things alternatives. We tend to be more of a mass affluent shop. So what we want is a one-ticket solution to get exposure to private credit, private real estate, private equity, so on and so forth. So let me do my due diligence.
Sounds good.
So what does make Monroe different? Because there are so many people here, some great companies. What makes you guys different?
Absolutely. So Monroe Capital is a private credit manager. And I think it's worth mentioning from the start that we've been around for 20 years. So in the private credit space, that's actually very long in the tooth. If you think back to the great financial crisis, before that, there really wasn't a designated asset class as private credit, yet we launched in 2004. So we've been doing this direct lending since
Let me pause on that for just 1 second.
Pre-era, yeah.
I didn't realize that. So before, when did private credit as an asset class really emerge? I guess I didn't know that.
Yeah, so when Dodd-Frank laws came into effect, or regulations, I should say, it really pulled back the bank channel's ability to make loans to these types of middle market companies, and that created the void and the need for lending and the need for financing, and hence kind of private credit was born. Now, it happened beforehand, it just wasn't as prevalent or as kind of a known entity. And when you think about the middle market, it is such a vast opportunity set. If you looked at a chart and looked at sizes of economies around the world, middle market would actually be the third, in the US alone, would be the third largest economy in the world.
Let's pause on that for a second. So middle market private credit, if you were to add it all up, is the third largest economy in the world?
Exactly.
Wow.
And you think about all those jobs in your communities, right? And you think about all those companies, and these could be, so that kind of leads, what's Monroe, what do? We specialize in companies that are the lower part of that market, what's referred to as the lower middle market. We're lending to companies that are 35 million in EBITDA or lower. Now, those are still very sized companies, and these are often family-run, multi-generational businesses that have been around 25, 30 years. What's relevant about that comment is if you think about when people think lower middle market, they hear lower, they hear smaller, I think the instinct is to feel like, oh, maybe it's riskier. So I'm here to tell you today, Chuck, I'm going to debunk that myth.
Fear not.
These companies have been around. They've been through interest rate cycles. They are established. I often refer to them as the non-sexy backbone of our communities. And by that, I mean these are often behind the curtains businesses that you wouldn't necessarily know the names of. You wouldn't recognize logos. You're not going to see a page in our deck that's going to have eye-popping, company names on it, because most of the companies we lend to, you would have never heard of. And so what makes us special and what we've done is really that experience of 20 years. Private credit, it's who we are, it's what we do, it's our ethos, right? And we are focusing, and we've stayed in that lane of these companies because we feel like there's such value to be had, and there's so much opportunity in that space that we've really opted to stay in that lower middle market channel. I think the other thing that makes Monroe really special is to work in that space, it requires a lot of hands on deck. So we're a 20 billion asset under management size firm. So 20 years, 20 billion, easy to remember. However, we have about 250 employees, and over almost half of those are investment professionals. And that is a really high ratio. It's probably appalling to some firms that we have that many investment professionals, because it takes that kind of digging in and really doing the due diligence on these companies to be involved. But the reward is there, right? You get a premium in your returns for it.
Okay, so there's a lot to unpack just with that. So I think for the audience that's not as familiar perhaps with private credit, and I'm speaking as if I am, I wasn't familiar with it 2 years ago before we decided to get into this, but I've really fallen in love with that space because I think it's an amazing space. Help the audience by comparing and contrasting, let's say you guys with a B cred, right? So you're the lower middle market, they're not, right? So expand on that just a little bit, please.
So private credit as a whole is a really basic concept, right? It's, again, as I said, these companies that maybe can no longer go to banks or don't want to for efficiency purposes, still need loans, right? They're making acquisitions, they're recapitalizing, refinancing, whatever they're doing, they need money like most businesses do. And so they're coming to the private markets. Now, that market, again, is a very large space, as we said, and you hear headlines all the time now about all this increased competition, and there's a lot of it. And BCRED has led that charge, and good for them. Blackstone has done a phenomenal job in really raising awareness of the space and kind of building up the space. But they're focusing on much larger companies. And there's only so many of those deals out there to be done in the upper part of the market. And now you've got a lot of competitors jumping in, right? So you've got a lot of competitors, fewer deals. The math will tell you who's in control when that happens, the borrower.
Right. So this actually is a good segue, because this is something else I wanted to know. And as I say, this is great because these are questions I'm asking for me,
right? And
we're just kind of sharing it with the rest of the audience here. But these are some really important things, because as we put together this fund to fund, we want to have different funds. We want diversification, but we don't want to have diversification by having 5 funds that all do the same thing.
Exactly.
So, but my question is this. One thing I am a little concerned about is all this money, including soon to be ours at our shop, flooding into private credit. Are we at the point where there's too much money chasing too few deals?
So again, in the upper market, you're going to see a little bit of that scenario. And so what will happen, and again, this isn't saying that those are bad funds or bad deals by any means. I would say, to your point, we're complementing what they're doing by being in a different space. So in the upper market, there are more players, fewer deals to be had because they're larger, so there's only going to be so many. Mm-hmm. I think in 2023, only 174 deals got executed in that space. And so if you're likely starting to see clubbing up. And what that means is you will have multiple players participating in the same deal. They're each kind of getting a slice. So as a result, you are... not only is the borrower kind of running the table and maybe bringing down spreads a little bit, a lot of the funds are going to start to look a little bit more alike. You're going to have some overlap. And so it's worth looking under the hood to kind of check that, so that diversification is actually there, that you're not just getting the same deals under a different umbrella.
Right. And frankly, that's something that we've been kind of aware of, right? So we're looking at these, and you look at some of the underlying makeups, and boy, they're kind of similar, right? Mm-hmm. So the whole idea of diversification is great, but if you're buying, just to use an ETF example, the S&P 500 from 5 different vendors, you still have the S&P 500.
Exactly.
Just 5 different brands.
So our exposure is going to be a differentiator and a complement to that. So being in the lower middle market, for example, last year, I think there were over 6,000 deals to be done.
Wow.
We vetted 2,200 of them and executed on less than 100. So we are still sitting in that seat of being able to be extremely selective. And everyone uses the funnel, but visualize a funnel, right? So we just have a much bigger funnel that can really narrow down for us to choose from, and we really control that. The other big difference in the lower middle market versus the upper market is really worth mentioning. Because we can kind of control things a little bit more where we sit, we can implement covenants on every deal that we do. Now, a covenant, for those that are less familiar, think of it as simple guardrails. It allows us, we say, okay, maybe this metric has a boundary, can only go down to this number, whether that's loan to value, EBITDA, whatever the number might be. And that allows us to kind of heighten kind of our involvement with the company and kind of step in and hopefully help right the ship. We're not out there to loan to own. We want to see these loans succeed. We make money by our loans getting paid back. So it's in our best interest to have those covenants, to have those tools in place to be able to kind of right the ship if we need to and see that success of that loan payoff. It allows for early intervention. We're not caught off guard. We know what's happening under the hood. And in the upper market, again, that increased competition makes it difficult for them to implement as many covenants as we can see in our space. And so I think that's a really key point and it's not saying that those deals are bad or the upper market, right? They complement each other, but it's just a different way to think about the managers.
Yeah, no, that is interesting. And it is helpful to understand the difference between, because not all private credit is the same. It's not one just monolithic group. So what I think I heard you say, and I just want to kind of confirm this, is it fair to say when you're dealing in the lower middle market, which is the space that you guys play in, you have more leverage because, not everyone is going after that business. So you have the ability to be a little bit more strict with the covenants that you put on.
Yep.
Is that right?
It's more strict, more selective, and more hands-on. And that takes effort and resources, but the result is we will get a higher spread on a deal than in the upper market. So that's the value we can bring to the table for our investors. And it really allows us, to your point, it rounds out your private credit exposure. Mm-hmm. There's no reason you won't want both upper market and lower market in a portfolio, just like you would never say, I'm just going to be focused on one type of equity.
Exactly. So it's not so much one or the other,
exactly.
But the same thing in building ETF portfolios, right? We're an ETF shop for our models and everything else. You don't want 5 different S&P 500s, as I said before.
Exactly.
You want some S&P, you want some emerging market, you want to have that diversification. Now, if we knew the one that was going to do best, we would just buy the one. But no one really does.
Probably Monroe Capital, but...
But if it were one, it's got to... Yeah. But if you had to, no. That's
we do
really
have
good.
a 5-year track record.
Really good. And so you kind of mentioned interest rates a little bit. So I did want to ask about that as well. So rates were going up. We were seeing very high distribution rates for you guys and everyone else. Rates are coming down. What does that mean?
Yeah, I think it's really important to understand the implication for both the borrowers and the investors. So let's kind of unpack those separately. So from the borrower standpoint, we went from a zero interest rate environment to a 17-year high. And people's biggest concern, rightly so, are these borrowers going to be able to make their interest rate payments to us?
That was a big concern of mine. We love those yields going up, but it's like, at what point are you choking out the client?
Exactly. And I would say last year at this time, that was like the number one question. So I can assure you that, again, having those covenants, dealing with companies that have been around 25, 30 years, put us in a good position, and our borrowers fared very well. That being said, we're now starting to come back down. So what does that mean? That will be a little relief for the borrowers in a good way, right? Help with their growth trajectories and so forth. Now, for the investor, what's interesting is when we were at a zero interest rate environment, we were still paying out 8% in our portfolio. Now, that's a reflection of, again, SOFR generally plus the spread we're getting in the market and any fees, et cetera. And we were able to maintain that during that environment. As rates went up, so did our distribution. We're currently sitting just over 11%, which is wonderful. But keep in mind, when a SOFR rate cut happens, it generally takes about 90 days for that to work into a portfolio across the board. We have over 200 loans in our portfolio, and all the reset dates are going to be unique to that loan. So assume it's a full quarter before that works in. Now, we expect there'll be more rate cuts, and so but I don't think anyone anticipates we're going back to zero.
Right.
Plus, we have floors on all our loans. So I think it's safe to say over the next, right now through the rest of this year, I think you should expect those payouts to stay very stable. Could you expect it to come down a little bit next year? Naturally, but I don't think anything dramatic. And again, as you look at that, when we were in a non-interest rate environment, our baseline was 8. Like that still gives you, I'm not going to sit here and predict our returns, but give you an idea that you should feel good about where the range will be able to sustain over the next couple of years.
I was going to say something similar to that, because no matter what, you don't know where SOFR is going to be, you don't know what the performance is going to be, but it's reasonable to believe that if rates go down really low, private credit, like at a shop like Monroe, would still be better than treasuries, obviously. I mean, you're getting the liquidity premium, the risk premium and everything else being properly managed, we hope. but it should always be higher than some of the alternatives.
Exactly. You're getting SOFR, plus a spread. And that's really, again, when you look at how a loan is structured, kind of, again, when you differentiate managers, there's what's the EBITDA of that firm, kind of what multiple are you lending at. So if we're lending to a $25 million EBITDA firm at a 4 times, that means that's a $100 million loan. And so you can do the math for the other companies as well. And then you look at that's like, if SOFR was at a high of 534, plus we were getting over 6%, right? Our all-in coupon's going to be in a certain range. So obviously you do the math and that can come down a little bit, but it's all, floating rate is the name of the game, and that's been to our advantage. But what you want to just, make sure that those managers, and I'm pretty sure most loans have it, would have a floor on that SOFR. For us, we maintain that there's always a floor. But that's just kind of, obviously it's a floating rate product.
All right, that sounds good. Well, Dayna Kleinman, thanks so much for helping us kick off our coverage here at CAIS. This was great information for me and hopefully the audience as well.
My pleasure. I really very excited to be here, excited for your search and your journey. You're kind of right there with a lot of managers. How do you embrace the space? Where does it fit into the portfolio? And, just taking the journey to learn about all these products. So happy to be part of it.
Absolutely. Okay, that's a great way to end this particular segment. This is our first of about, I think we're doing 8 or so over the next, between today and tomorrow. So stay tuned. And on behalf of goRIA, fueled by Investment News, I'm Chuck Vela. And we'll be back in about another hour and a half with our next segment. Thanks for joining us. And Dayna, thanks again.
Thank you.
Okay.